Most finance experts agree that we're currently in the midst of a global recession. And this is definitely not the first time, as there is usually a recession of one size or another every 15 to 20 years or so. But are we headed for a depression too? And what exactly is a depression? Or a recession for that matter? And what is the difference between the two? I'm Kim, and that is exactly what we're talking about today. Ready? Let's go! Right now, everyone is talking about the recession. What does it mean though? A recession is usually thought of as a widespread drop in economic activity that lasts for more than a few months. We measure this by looking at the gross domestic product, or GDP. If the GDP drops for a second consecutive quarter of the year, that is when most consider the economy is in a recession. But that's not the only way a recession can be measured. Here are 5 things that constitute a recession. First, there is GDP, as we just mentioned. But what is a GDP? These are the goods and services produced in the country during a certain time period. So, the value of all these goods and services is added up, and that gives us the GDP. When the GDP shrinks for 2 or more quarters, a recession happens. The second way to measure a recession is the unemployment rate. During the 2008 recession, unemployment reached about 9%. This may not seem like a lot, but when you consider that there are 330 million people in the US, that's about 30 million people out of work. Number 3 is household income. In recent years, people's attitudes towards money has changed. People used to try to save 20% of their income, but today, most spend all of it. For example, purchasing cars, gadgets, and overusing credit cards. When there is a recession, wages tend to stay the same, or plateau, or they can even go down. This means that fewer people are applying for jobs. It's a simple matter of supply and demand. When there are more people looking for fewer jobs, wages go down because employers know they'll have to pay less. The fourth item on the list is retail sales. When retail sales start to drop, it's a clear sign that a recession may be coming. If people aren't buying things, then production slows down. And since GDP is a measure of goods and services, if there are less of them, then it is a sign of a slowing economy. The fifth and last way to measure a recession is a drop in the number of factories. The manufacturing industry is often the first to be hurt, because when people spend less on goods, there is less demand for the products that manufacturers make. So, now that we understand the idea of a recession, how is it different than a depression? In a financial recession, there is less money in circulation. Because of this, most business owners are retrenching, which is when companies reduce costs or spending in response to economic difficulty. This affects bigger purchases like home loans, car loans, and loan payments. When people stop making these payments, there are more repossessed cars or foreclosures, like in the 2008 housing crash. A depression, however, is different. Many economists say that depressions are so rare that it would take something catastrophic for it to happen. A depression is essentially a much worse recession that lasts for at least 2 years. Many experts say that the Great Depression was caused by 2 recessions that happened back to back. The first one was from 1929 to 1933, which was about 3.5 years. And the second one was from 1937 to 1938, which was about a year. Many experts think that the Great Depression was caused by mistakes in the way the Federal Reserve handled money and finances. Since there has only been one major market depression, we'll use that as an example. The first cause of the Great Depression was the GDP. Again, these are all the goods and services that a country makes which are added up. But during the Great Depression, almost all manufacturing and services halted. So the GDP essentially ground to a halt. The second cause was house prices falling by 30%. The overall value of the housing market was severely depressed, contributing to the overall economic depression across the country. The third factor is unemployment. This reached an astronomical 25%, which is almost 80 million people by today's standards. When compared to the 2008 recession, when unemployment peaked at around 11% in 2009, the difference is clear. More than twice as many people were out of work during the Great Depression. Finally, the fourth cause of the Great Depression was a reduction in retail sales. Retail sales fell off a cliff during the Great Depression. They stopped almost completely, and prices dropped by a huge 10%. You might think lower prices is a good thing, but in anticipation of prices continuing to go down, many people start to save their money. This is a bad idea. This sort of careless action can lead to deflation, which, trust me, is something we don't want. Deflation, in case you don't know, is the reduction of the general level of prices in an economy. And while the effects of a recession are pretty bad, the consequences of a depression are much, much worse. There is another important distinction about the Great Depression that is worth pointing out. Between 1929 and 1933, world trade dropped by a whopping 65%. So what does this all boil down to? A recession, according to the National Bureau of Economic Research, is a big drop in economic activity that lasts for more than a few months and can be seen in inflation-adjusted GDP growth. A depression, on the other hand, is basically a very severe recession that lasts for a much longer time and has substantially worse economic indicators. For example, an unemployment rate of 10% is considered a recession, but an unemployment rate of 22% would be considered a depression. In the last 180 years, there have been 30 recessions, which averages to about one every 6 years. But there has only been one Great Depression in 1929. That is, once every 180 years. So, a recession happens about 30 times more often than a depression. If you find yourself in a recession, the best thing you can do is figure out the steps to be as financially ready as possible. Secure steady employment and try to make the most of low interest rates to save as much money as you can. Sure, a recession is looming over us all, like the upside down is looming over the town of Hawkins, Indiana, but that doesn't mean we need to go hole up in some Russian work camp like Chief Hopper. Armed with a bit of knowledge and understanding, we can weather these storms. And to help you out, watch this video where I show you exactly how to save and invest during a recession. See you there!